The manager of the world's biggest bond fund says the debt deal signed by President Obama today doesn't even come close to doing what's necessary. Bill Gross manages the $245 billion Pimco Total Return Fund. It's a fund that's beat nearly all its peers over the past 5 years. He says trillions of dollars more in spending cuts and tax hikes are needed. He joins us now from Newport Beach, California. Bill, great to have you here on Street Smart.
Thank you, Carol.
It's interesting. We've been talking to a lot of folks, Peter Orszag yesterday, and saying, these deficit numbers that we're fixated on, like you, don't even come close. What specifically are you keying in on that you think everybody kind of has to pay attention to?
Well, I think very few people have focused on liabilities over the longer term. I mean, we have a $10 trillion, $12 trillion debt, Carol, but basically we also have $60 trillion present cost in terms of future liabilities. We're talking about Medicare, Medicaid, and Social Security. I called those debt. That means D-E-B-T, debt men walking. That basically means that in addition to paper, we've got people. We've got 330 million people that are walking around as future liabilities for this country. And to the extent that we have promised them entitlements through health care and through Social Security, that total is $60 trillion. That's 6 times the existing debt. And so we've got a whale of a program to go, not just in terms of this particular targeted program, but in terms of forward years where $1 trillion or $2 trillion have to come off of the budget almost every year in order to maintain some semblance of a AAA type of company and country.
Bill, what I want to ask you is, how do we fix this situation? I mean, lawmakers spend how much time trying to get it together? For a while, we heard about a balanced approach. You actually say a balanced approach makes sense. You talk about further spending cuts and trillions of dollars of tax hikes. Can we get to a balanced approach? It seems like lawmakers couldn't do it.
Well, I think we do. It does seem like lawmakers can't get to it, and whether they will in November and beyond is, I think, a critical question. To our way of thinking, tax hikes have to be part of the equation, and we're talking about not only tax hikes, yes, for the billionaires and for the hedge funds in terms of carried interest, but we're talking about corporations as well. Corporations have the lowest tax rate on a historical basis, 10% of GDP that they've had for the past century. And so those that would suggest that corporations won't invest unless their taxes are reduced, I think are sadly mistaken. It needs to be a balanced approach, and it needs to be significant.
It's interesting that you say that. I mean, Bill, are you kind of disappointed in the president here? Paul Krugman telling us yesterday, he wrote it in the Times, he talked with us, the president surrendered, he gave back on so many issues. Are you disappointed that the president didn't push further with the Republicans and the conservatives?
Oh, yeah, I think so. I mean, he had his chance perhaps long ago when simply he could have threatened to raise the debt ceiling come hell or high water, I guess, come 14th Amendment or high water. And that certainly wasn't the case in terms of him following through. So I'm disappointed. I think there have to be tax increases. I think that was his main premise. He didn't enforce that. And so, to me, it's a Republican Tea Party victory. Whether they can continue that momentum in 2012, we'll have to see in terms of the elections.
Bill, I'm curious, if we had gotten more significant spending cuts and if we had gotten tax increases in the legislation that the lawmakers ultimately voted on, what do you think we would have seen in the markets? I mean, we're watching the sell-off certainly here on the equity side. How do you think the markets would have reacted?
Well, probably not much differently. I mean, the markets, and you can take Pimco as an example, are very skeptical in terms of any plan. And there could have been a $4.5 trillion grand bargain, I suppose, with out-year types of entitlement cuts and maybe even some tax increases disguised as they were. But in any case, the markets, I think, are skeptical of what government can do in this particular situation. It is true from our standpoint, although we're recommending, that there's a long way to go in terms of reducing deficits, that when you do it in the short run, as the Tea Party would not recognize, as you do it in the short run, that's very fiscally contractionary. Over the next year or two, the U.S. government, even under the guise of this particular plan, will be fiscally contractionary to the extent of 0.5% or 1% of GDP, and that suggests that the private sector has to come in and fill the breach, and we don't think really that they're going to do that.
So then what happens? Paul Krugman argues that we need, this is not the time to do spending cuts. It's the completely wrong time to do it. Based on what we're seeing in the economic data, it's hard to disagree with him. I mean, is he right? Do you think that that's what we need from the government? We look at those GDP revisions. They were really, really disappointing.
Well, they were, and I think even Krugman would agree that up until this point, the stimulus programs have been misguided. They've promoted consumption and basically Chinese production as opposed to U.S. production. The future programs, basically, if they're going to be future programs from the standpoint of fiscal stimulus, they have to be directed at jobs. They have to promote infrastructure. They have to promote green and technologically advanced types of programs such that we can, again, export something to the global economy. At the moment, basically, we only import something from the global economy, and that's one of the problems that we have.
Bill, you guys over at Pimco, are you setting up for another recession here at this point? It seems like, we had talk a while ago, it died down, and it seems like it's up again. Are you guys banking on another recession here?
Well, not yet. Right now, we're talking about it in investment committee. I came down from investment committee to do this program, and we're talking about those types of things. Our numbers, basically, for the second half are 1% to 2% in terms of real GDP growth. They were 2% to 3%, so we've reduced that based upon recent statistics. So we're not looking at a recession yet, but we're at a tipping point, Carol. We are at what we call a stall speed, in which corporate profits don't grow, jobs aren't created,
right.
Therefore the economy sinks, based on a stall speed concept in terms of airplanes.
It certainly doesn't feel good. Bill, let me ask you, what about the Federal Reserve at this point? They've got to be watching this very, very closely. Should we expect, do we need the Fed to do something more? Or with rates so low, pretty much all along the yield curve, do they need to do anything more?
Yes, we've talked about that too. What can they do? I mean, the Fed's in the business of providing emergency liquidity and reducing the cost of credit. They've done a lot of that. I mean, the 5 years at 1.2%, the 10 years at 2.65%. They can do additional things. They've suggested they can do additional things. They'll talk about it here next week, and they'll talk about it at Jackson Hole. There's the potential for a QE3. I suggest, however, that takes the form really of language, of extended period language, and maybe some type of cap on 5 or even 10-year Treasury securities going forward that would lower the cost of credit even more. But they are at a point, they're approaching a cul-de-sac, a dead end in which all they can do has been done.
All right. Hey, Bill, I love your note because you talk about Davy Crockett in a speech to Congress back in 1830. You said the time for funnin' is over. So with that in mind, your advice to investors at this point is to continue to look outside the U.S., correct?
I think so. You want to be non-dollar based, importantly, Carol. And as interest rates come down in the U.S., that basically suggests that the dollar's a less and less attractive investment. And so you want countries with what we call cleaner, dirty shirts. You want Germany, you want Canada, you want perhaps Brazil and Mexico with half the debt that the United States has, but with interest rates, 2, 3, 4, 5, 6%. So that's one way on the bond side. Basically, you want to look for commodities which benefit with a declining dollar, and you want to look for global stocks that pay a consistent 3% plus type of dividend relative to the dramatically low interest rates that we have in the United States.
Hey, Bill, just got a few seconds left here, and you're sticking by your call for the most part against U.S. Treasuries. Is that right?
Well, the call on U.S. Treasuries was always that there was something better, that there was a cleaner, dirty shirt. And we've benefited, yes, from Germany and Canada. We're doing quite well in terms of the total return fund. It's up about 5%. It's beating the pack in terms of performance. So we're doing fine. Treasuries can do what they do, but, we're in the cleaner, dirty shirt types of countries.
All right. So wait, I'm going to say that that's a yes, that you are still staying against U.S. Treasuries?
Well, we have a small percentage of U.S. Treasuries. I say that the total return portfolio has about a 9% concentration in U.S. Treasuries, and that's up just a little from last month. Those numbers will come out in the next few days, and I hope I haven't disturbed our legal people. Sorry.
I hope you haven't either, and I didn't certainly mean to have you do that. Hey, Bill, we love getting time with you. Thank you so much.
Thank you, Carol.
Bill Gross over at Pimco.